Hi and welcome to Swissquote's Daily Market Talk. It's Monday, November 18th. Last week's US inflation data and not so dovish comments from the Fed Chair Jerome Powell left US equity bulls with a bitter taste in their mouths. So this week, all eyes turn to major US retailers' earnings and Nvidia's report as well, as investors hope that the AI darling's strong performance could eventually give a fresh boost to sentiment this week. So in case you missed, the US retail sales and the US inflation data, especially the PPI numbers, came in higher than expected last week. And the Fed Chair Jerome Powell said, again last week, that the US economy is strong enough and that there is no urge for rushing towards the interest rate cuts from here. So that's obviously not something that the Fed does and the market bulls wanted to hear. Although, well, you could have guessed that at some point in time, the Federal Reserve members would just open their eyes and succumb to the reality that the US economic data remains just too strong to continue cutting the interest rates at the speed that they have been proceeding since September this year. So, last week's economic data and Fed comments, so the uptick in the US inflation and Powell's reckoning that things are not collapsing in the US particularly, were no surprise to many people out there, at least not to me, as you know if you follow these market talks regularly. But putting that black on white actually gave investors around the world some reason to further dash their treasury holdings and rush toward the US dollar. As such, while the US 2-year yield consolidated last week between the 4.30 and 4.40% levels, the US 10-year yield shortly spiked to 4.5% level, and the US dollar index traded at the highest levels that we have seen in more than a year. Now, the US yields and the US dollar are softer this morning, but activity on Fed funds futures still gives around 65% chance for a 25 base point cut in Fed's December meeting. And I think that there is room for a further hawkish readjustment on this front. Because look, even if the next jobs data from the US disappoints, for example, the rising inflation expectations for the US will likely tame the bets of further rate cuts from the Fed. And this is especially true with Donald Trump's pro-growth policies and hefty tariffs that actually threaten to give an additional boost to inflationary pressures in the US. Now, good news is that this week's economic data is light, so investors around the world will find a window to digest and to breathe after some hectic weeks since the US election. So we could see some consolidation and some correction in both the US Treasuries and the US dollar, because the euro dollar, for example, which tested the 105 psychological support last week, could very well recover this week from the oversold market territory, and the dollar yen, for example, could form some resistance near the 155 psychological level. But the rising risk for US inflation will likely remain the major narrative of the market and should limit the appreciation potential of these major peers against the US dollar. Now, looking at the market levels, the euro dollar should actually see a minor resistance near 106.70 level moving forward. That's the minor 23.6% Fibonacci retracement on summer to now sell-off in the euro dollar, and it could see a major resistance near the 107.70 level. That's the major 38.2% Fibonacci retracement. Now, for day traders, the 200-hour moving average, for example, could be an interesting metric to watch and to monitor in order to determine whether the winds are turning direction for the euro dollar. In dollar yen, the minor 23.6% Fibonacci support sits near the 152.80 mark, while two major supports could be found near the 200-day moving average, near 151.90 level, and near 150.30 mark, which is the major 38.2% Fibonacci retracement that should distinguish between the actual positive trend in the dollar yen and a medium-term bearish reversal. For cable, the 128-128.20 range shelters the minor 23.6% Fibonacci retracement and the 200-day moving average, while solid resistance is seen near the 129.20, which is the major 38.2% Fibonacci retracement here. Again, we have a light week in terms of economic calendar. The Canadian, the Eurozone, and British inflation numbers will be the most closely watched economic data. There is not much suspense for the Eurozone inflation, mind you, as major Eurozone economies have already printed their inflation figures. So the Eurozone inflation is seen steadying near the 2.7% mark, but the British inflation is expected to rebound above the 2% mark, while inflation in Canada could show signs of heating on a monthly basis. So, if that's the case, if the inflation data around the world tames the dovish central bank expectations elsewhere than the US as well, then we could eventually see the major peers rebound and recover against the presently overbought US dollar. But as long as the major technical levels are not breached, I would consider that the rising inflation threat for the US should keep the medium-term outlook for the US dollar tilted toward the upside. Voila, that's how I see the FX markets if we combine the fundamentals with technicals. In the energy markets, investors repeatedly knock crude oil back down each time it tries to recover. So the barrel of US crude tumbled more than 2% on Friday's trading session and tipped a toe below the $67 per barrel level this morning. Higher supply versus weak global demand outlook keeps the oil bears in charge of the market right now. So the price rallies time to time serve to strengthen the bearish positions in oil markets in expectation to see the barrel of US crude extend losses towards $65 per barrel level, for example. Now, a solid support is seen for Brent crude approaching the $70 per barrel psychological support as well. But unless the macroeconomic narrative doesn't change with a stronger China, for example, and lower global oil output, which could be possible, by the way, in case of renewed geopolitical tensions. But if these are not happening, well, the oil bears will likely dominate the field. In the equity space, well, last week ended on a sour note, really. I mean, the European equities were already bearing the brunt of the tariff threats from the US. So the SOX 600 index actually remained downbeat last week, and that despite the rising dovish expectations for the ECB that gave kind of boost here and there, while the major US indices were also hit by a sell-off last week on the back of a hawkish shift in the Federal Reserve expectations. So the Dow Jones retreated 1.24% last week. The S&P 500 slipped more than 2%. Nasdaq 100 dropped around 3.40%, while the Russell 2000 index lost around 4%. Now this week, attention shifts from politics and economic data to earnings. Hallelujah! So big names like Walmart and Target and yes, Nvidia will be reporting their third quarter earnings this week. So the big US retailers will probably give an indication on the health of the US consumers, while Nvidia will likely confirm the strength of AI demand. Now, note that not all semiconductor players are doing well right now. Applied Materials, for example, dropped more than 9% on Friday's trading session after giving a softer than expected outlook for the current quarter. But I would actually be really surprised if Nvidia came up this week and just gave a soft outlook after a CEO said just a few weeks earlier, remember, that the company sees an insane demand for its next generation Blackwell chips. Insane demand. So it goes without saying that all that insaneness is already priced into Nvidia's share price. Therefore, nothing other than another very strong beat in revenue and earnings and a strong outlook would guarantee a further extension of Nvidia's rally. But we will see what happens. So exciting. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will see you again tomorrow. And until then, good day trading.